Do you want to know if we can predict the bottom of a market with a deep correction or crash, such as during the last COVID crash in year 2020, during the US-China war trade in year 2018? Hello everyone! In this video, I'm going to share two powerful indicators which can synergize well with each other to anticipate the bottom of the market has reached. This video was inspired by my mentor's video. Thus, I did my own research to backtest this strategy, and it works wonder. Recently, the signals have shown that the next step is potentially reaching the bottom. There are two indicators involved. The first one is Williams percentage R. Williams percentage R is a type of momentum indicator that moves between 0 and -100 and measures overbought and oversold levels. A reading above -20 is overbought, while a reading below -80 is oversold, where there is a potential for a price bounce. In this video, I will be using Williams percentage R of over 52 period using a weekly chart. Please note that for the video today, all the chart will be using weekly candles as I found that it is more reliable. Let us see how this indicator works. Let me use XPS as an example. Let's backtest Williams percentage R all the way to year 2000. I will mark it when the signal is at the oversold region. The return is estimated based on the distance from the oversold region until the last period at the overbought region. The most recent overbought region is on 16 March 20, the COVID crash. The correction was around 35% and we entered bear market. Then the market rallied for 102%. Next was 17 December 18. During the US-China trade war, the correction was 20%, just right to dip into the bear territory. After the Williams percentage R short and oversold signal, the market rallied 38%. The next one was on 11 Jan 16. The correction was 14%. After the oversold signal, the market rallied 53%. Then, Black Monday 2011 on 26 September 11 dipped the market for 22%, another bear territory. After the oversold signal was shown, the market rallied 85%. For the past 10 years, only 4 signals were shown and it managed to predict the bottom accurately. The next bear market was an infamous one, subprime mortgage crisis in year 2009. The market crashed for 58%, while the Williams percentage R managed to anticipate the bottom on 23 February 09. Previously, it gave us 5 false signals and the market dipped deeper. By the way, then the market rallied 97%. Next is the dot-com bubble crash in year 2002 to 2003. The real bottom predicted by the signal was on 3 March 03. However, previously, 6 false signals were observed. The market then rallied 87%. Although the Williams percentage R alone managed to anticipate the bottoms accurately 4 out of the 6 deep corrections in the last 20 years. However, it also shows a major limitation of this indicator. The key limitation of Williams percentage R is too responsive, meaning it gives many false signals. This is a typical weakness of a leading indicator. Therefore, we need another indicator to streamline the Williams percentage R to anticipate the bottom is reaching. The indicator is normalized ATR. Let us understand what ATR is first. ATR is average true range, and it is market volatility indicator. High ATR means the market volatility is high. For example, in a less volatile market, Nasdaq Composite Index is generally moved between 1%. However, since December 2021, the market is extremely volatile, where the Nasdaq Composite Index could move more than 2% per day frequently. This can be seen from the range of the daily candle. Before December 2021, period before the yellow line, we could see that the candles are generally shorter. In contrast, there are many big candles can be seen after December, as indicated by the small red and green arrows. Volatility after December is higher, and thus ATR is higher too, as shown by the ATR indicator here. The indicator that we are going to use is called normalized ATR, which means it displays ATR as a percentage instead of absolute price. Normalized ATR creates a moving average of the volatility of a product going back X number of periods. The ATR period used is 14, and we normalize with 52 periods as 1 year has 52 weeks. Let us open the chart again. Now, we are looking for the region where Williams percentage R is showing oversold signal, but the normalized ATR is above 80. When this happens, we call it signal converge. Let us scroll through the chart. For the past 10 years, the normalized ATR managed to converge with the Williams percentage R signal. The COVID crash, the trade war, year 15 to 16 sort of, and the Black Monday 2011. Thus, these two indicators managed to work together and predict the bottom accurately. But can it catch the bottom or reduce the false signal for subprime crisis and dot-com bubble crash? During the subprime crisis, the converged signal showed that the bottom was on 6 October 08, where the price was higher than using the Williams percentage R alone. However, the number of false signals reduced from 5 to 2. If we manage our capital and cash flow properly, 3 rounds of dollar cost averaging are good enough for us to bring good profit, as the market rallied 50% from the converged signal. How about the dot-com bubble? The converged signal managed to anticipate the bottom. Instead of 6 false signals, if we use Williams percentage R alone, no false signal was observed if normalized ATR is also used. The market was then rallied 95%. For the past 20 years, both Williams percentage R and normalized ATR managed to catch 5 out of the 6 bottom accurately. Amazing, right? This is the summary table for what I have mentioned just now for your reference. Hope you managed to gain some insight here. Please subscribe my channel and give me a like to motivate me to prepare more quality videos. How about Nasdaq Composite Index? Instead of the period 52, I will normalize it based on period 12 or 1 quarter. Let me quickly scroll through the backtest results. The recent Nasdaq Composite Index falls into bear territory with a 22% sell-off. On 7 March 22, both indicators indeed have converged to each other. Thus, I think that the bottom is near. Similar to the XPX, these two indicators managed to catch the bottom of COVID-19 crash, US-China trade war, year 15-16 sell-off, and the Black Monday 2011. For the subprime crisis, there was a false signal, but we still could anticipate the bottom here. Interestingly, there was a mini bear in year 2006 with 20% sell-off, and these two indicators also managed to catch the bottom. Last but not least, during the dot-com bubble crash, where the tech stocks were suffered the most, it gave us a false signal, and then the bottom was caught, followed by a rally of 52%. From this summary table, we can see that the combination of these two indicators managed to catch the bottom 5 out of the 7 deep corrections of bear market accurately. What are your strategies to anticipate the bottom? Share with us in the comment below. Next, I will be sharing the limitation of this strategy. Not for daily chart analysis, it will be a lot of false signals. not suitable for individual stock. The reason for these two indicators work so well together is because of US stock index is always going up. Thus, whenever the market is correcting, institute or big fish will sure buy the dip and push the stock higher. Thus, applying this strategy is not recommended for individual stock, as the individual stock is largely depending on the fundamental and many other factors. However, since we know that most stocks are moving in the same direction with index, once we identify the signal from the index, we can then check the buy or sell signals of the individual stock. Even when two indicators converge to each other, it does not mean the exact bottom has reached. It may still going down a bit or consolidate for a while before going out. Never show hand and please manage the capital well. For example, buy the dip by controlling your cash ratio and leverage down if the signal is false and the next bottom signal is strong again. For example, even though during the subprime mortgage crisis, we trapped by the first false signal, but if we conserve our capital well, we can still buy the next dip when both signals converge again. Thereafter, we can just ride the trend. On the other hand, these two indicators help us to filter out a lot of noise without wasting a lot of our cash to buy the dip. You may notice that the normalized ATR is not available in your broker software. Don't worry, in the next video, I will be sharing a tutorial video on how to set out all the indicators used in this video. Please remember to subscribe my channel and turn on the notification bell so you won't miss my tutorial video when I publish it. Thank you and see you in the next video.